All right. Thanks, everybody. I'm David Leach. We may have a couple more coming in, but wanted to get started. We are the last panel of the day, so wanted to thank you for sticking around. Thank you to our sponsors. Thank you most especially to the panelists, who I'll introduce in just a moment. And thanks to all the attendees. So thanks for coming today. As I said, we're the last panel of the day. We're also the least cool, least techie of the day, least smart of the day. We're your finance geeks. So this is the panel on investing. And so it's a little different spin, same themes, same topics, but a very different perspective. And so what we're going to try to do is bring to the concept of technology and everything you've heard today about the technology sector, security, privacy, all those areas. How does an investor think about that? We've also got the great joy, I should say, of standing between you and Hayden and cocktails. So we're going to try to fill that time slot as productively as we can without sort of overstaying our welcome. I'm a principal at the Chertoff Group. Pleased to be here. I appreciate friends and colleagues joining the panel today. These are gentlemen I've worked with as clients, as an advisor, as colleagues and partners over the years. And the good news is we've got a range of perspectives. And so, again, in the consistency of what we're doing today, talking about technology, talking about innovation, really what we're talking about is investing, particularly on the private equity side. So this is not what's your favorite stock pick today or what ETF should I buy or mutual fund should I invest in. It's all about the allocation of private equity to spark innovation. And private capital is really a lifeblood for further innovation, for startup companies, for the efficient flow of capital to the best ideas. And really we'll come back to that theme a couple of times. The good news is one of the things we're going to talk about is a range of private equity. When you think about investing in private equity, there's a couple of different ways to look at it. There's early stage, there's venture capital, there's private equity, there's LBO, there's also corporate ventures, corporate investing, and then also sort of angel investing, and then there's a CEO perspective. And so in the panel today, you're going to see that range. We're starting from the far left with Drew Drake. From a corporate perspective, he's a corporate venture investor. He's been corporate M&A. He's worked at Lockheed Martin. He's worked at SRA, and now he's at SAP. So he'll give us his perspective from the corporate side of the marketplace. Mike Gozycki, to his right, is at Carlyle Group. Within Carlyle, he's focused in the Carlyle Equity Opportunity Fund, which is a growth fund. So it's not late-stage LBO. It's also not early-stage venture capital. It's kind of that growth stage that we'll talk more about, and we'll get Mike's perspective on what it means to be a growth company and how Carlyle evaluates that space. Mark Midikidishin, to his right, has a range of perspectives as well. We're gonna use him in a couple different places. As a venture capital background, he's done a lot in the venture world. He's done some of the private equity world. He's also been a CEO and a chairman of venture-backed and private equity-backed companies. So we'll ask Mark the perspective of being a CEO, thinking about how you evaluate different venture partners. And Nick is a partner at Insight Venture Partners, and so more of the traditional venture capital, earlier stage, but also they have a broader mandate. They go from early stage VC to late stage VC to early stage growth, and so there's a couple different perspectives there. So that's the introduction. I'll do much less talking going forward. Our format is I'm going to tee up one question for each of the panelists just to let them introduce themselves. It's sort of tailored to what they do in the area they focus on. And then after we do that, we'll do a little bit of a speed round. So we'll keep you awake. We'll give short questions, short answers, and sort of let them battle it out, give you a couple of different views on one topic, and then we'll save room for questions at the end. So let me start. We're going to do this hopefully a little bit strategically as we think about going down the range of, we'll start with Nick on the venture side. So Nick, we talked about Insight Venture Partners. You can give us more detail there. As you think about technology investing as a venture capital partner and a venture partner, what qualifies as the right stage of company for you? From startup, so maybe too early, LBOs too late. How do you think about the right stage of company life cycle for your approach?
So thank you, and it's great to be here, so thank you to the Chertoff Group and all the sponsors. So Insight Venture Partners is about a 20-year-old fund. We invest from the middle venture stages all the way through the growth and even majority or buyout opportunities. So it's kind of a diversity of approaches. We recently closed a $5 billion, or 4.75 to be precise, fund this year. And we exclusively focus on software and internet companies, both in the consumer and the enterprise space. So that means that we tend to invest on the small side, $15 or $20 million into a company, and on the high side, several $100 million into a company. And so what that means is we're typically looking for businesses, and this is true in the cybersecurity space, that have some traction in the marketplace. One of the things that I'm helping the portfolio with is we have a lot of great companies that have great traction in the enterprise space and are just starting to get some good traction in the federal space. And so that's actually an opportunity, given that I spent the last 5.5 years in the federal government, and the last 4 in the White House, and the last 2 as the Deputy U.S. Chief Technology Officer. So I can advise some of our portfolio on how do they build a federal practice and take some of that great technology that they've built and are deploying in the enterprise space to the federal markets.
Great. And we're going to come back to that theme and Nick's understanding his sort of experience in the White House, but we'll come back to that with a couple questions a little bit later. One transition as you think about life cycle of companies and life stage from where Nick sits to where Mike sits inside of Carlyle. Within Carlyle, obviously it's the Equity Opportunity Fund. Mike, what are the thresholds you look at for how big a company has to be, how mature they have to be, where they're sizable enough for Carlyle, but they're still in the growth stage and attractive for the upside?
Sure, David. And I'll try to explain where we fit within Carlyle, how that affects our mandate, and how it affects our ability to invest in technology. So within Carlyle, it's a big firm, $200 billion of assets under management across 200 individual funds. We have debt funds, we have hedge funds, we have real estate, real asset funds, but our lineage, our legacy is probably on the corporate private equity side. When you think of corporate private equity, you probably think of our large cap North American fund, which is a $13 billion fund. They do all the deals that you see on the front of the Wall Street Journal, like Booz Allen, Hamilton, Dunkin' Donuts, Beats by Dr. Dre. So that's kind of the area that probably comes to mind when you think of Carlyle. I work in the middle market fund, where you have about approximately $2 billion of assets under management, and 20 investment professionals. We're generalists, and all day long we look at, I would call them growth or small cap companies. Our equity check is typically anywhere from 20 million up to approximately 200 million or so. And I'd say the biggest challenge that we face in our market is just the perception that we often hear, Carlyle doesn't do small deals. In fact, we do, and that's all we live and breathe, and that's where we spend our time focusing. In terms of maturity, I guess the way I think about it is, we typically invest in businesses that are cash flow positive, although not always. We typically finance a portion of any acquisition that we do with debt, again, not always. But they're definitely further along on the maturity curve from a growth perspective. I guess the last thing I would say is you think about the different markets, and especially the current state of the markets right now. Carlyle, we're a traditional and conservative investor. We've put a high value on cash flows and a conservative nature. We typically try to target 3 times return on our invested capital, and we'll really put value on a very tight sample size and distribution, as opposed to shooting for outside returns. So in this market, it's been difficult for us to deploy capital in the technology space with valuations being so high.
We'll come back to that too. Thanks, Mike.
Yep.
If I switch to Mark, Mark Mikatishin is our resident current chairman, but a background in military and in venture capital and private equity. Mark, as you're thinking about taking money or partnering with venture capitalists, given you've been on that side of the table and now you're on the chairman CEO side of it, what do you look for in a partner? Who's the right venture partner to join the family?
Well, first, Dave, thanks for having me. I must say, based on the introduction, after having spent years getting my PhD, that landed me firmly in the camp of being one of the dumbest guys in the room. So I take all my answers with a grain of salt here. But I think for having been, like you said, a venture capitalist and looked at early stage growth companies and been on the private equity side where you're looking to buy companies more or less and being defined more as a control position. I mean, for me, the right investment partner it really is just that. It's really a partnership. And it's important for the companies to realize, where they are in the stage of their life cycle and phase of growth and what type of partner is going to best be suited for them. But for me, it kind of starts with the basics that the management team, the premise here is that the management team has already come to the conclusion that they've got a strategic plan that they think enables them to achieve the type of end result or outcome that they want. And so the first step in the partnership for me anyway is to, as I look at the wide variety of firms that are available to provide that financing and realizing that it's really not about the money. The people on this panel represent, hundreds of billions of dollars of capital, for example. It's really about, at a high level, do I feel that the people from whom I'm taking money actually have the capabilities to successfully help me achieve the strategic plan that we've put in place? Mm-hmm. And then what are the things that we're looking at, with regard, to that partnership? Are these, real estate investors who are looking to fund an early stage technology company? Right. Do they understand the nuances of how to build, a technology specific business within the context of the broader marketplace? That type of thing.
Thanks, Mark. And Drew, I told him earlier, he's my favorite panelist because he's the name least likely to trip me up. Drew Drake, with a lot of corporate experience, a couple of different big corporations, now with SAP, and inside of SAP, working on the NS2 platform. And as an investor, you're competing at sometimes, I assume, with the venture capitalists, with the Carlyles of the world, trying to become the owner or the part owner of high technology companies. What's your value proposition when you go to those companies and say, this is good for you and it's good for me? And sort of that dual proposition of, it's got to be a financial return for you, but it's also got to drive sales of the NS2 platform.
Sure. First, thanks for having me. Just to give my comments a little context, I work for an independently governed subsidiary of big global SAP, focused exclusively in the national security world, including cybersecurity. To your question, I don't view these guys as competition. And in fact, in a lot of instances, I would view them as a partner. I think we're a very complementary form of capital. We're, as a strategic, obviously I look through a different lens. I'm not so much focused on trying to solve for 10x, 5 years from now. It's more about near-term revenue, as you're saying. But, we're approaching this, I think, a little bit differently, even as a strategic, trying to be a very friendly form of capital. I bring a big logo. I bring a lot of resources with me. I bring a huge channel. I'm trying to approach targets without drowning them in strategic partnership agreements that are 150 pages long, like some may do. So what I offer is, a logo, our resources, our support, and also our capital on pretty flexible terms. I don't have to fit my investments in a little box, that, exactly this size, these kinds of securities, et cetera. I'm trying to drive meaningful partnerships that drive near-term, intermediate, and long-term revenue before I'm trying to drive balance sheet returns. So that gives me a lot of flexibility and shifts the emphasis a little bit away from negotiating definitive docs and maybe more towards, the partnership doc. So it's been a great model. Companies have adopted the story pretty well. So in some respects it's competition, but I hope to get to the point where, we view each other as adding value in different ways.
Good. I'm doing a lousy job of sparking controversy up here. You guys are cooperating. That wasn't my intent with that.
That's what I say up here, but when I'm competing, it's
not what he said
different.
backstage.
Yeah, exactly. We're going to go, and this one I'll direct to Mike and Nick specifically, as you think about, because Mike made the point, it's tough to deploy capital in an environment where valuations seem to race ahead of you, or you've got certain parameters you look for, certain return thresholds you have to hit when you go to committee and tell your LPs you're being a good steward of their capital. What's the environment like today? Is it easy to find good, high-quality investments, but hard to get the valuation? Or there's just not enough good ideas out there, not enough good management? How are you deploying capital in the technology space right now?
So I'd say that there are so many fantastic companies, entrepreneurs, technologies that are attacking so many great problems, both on the consumer side and on the enterprise side. And so that's the good news, right? And that's really fantastic. It really is software eats the world. And so we're seeing this in so many different ways. And there are great business models behind it too. So you have much more recurring revenue and predictable business models. So all of that's great. The challenge is that there's also a lot of capital and a lot of enthusiasm. And so the prices are high for investors. And so that makes it challenging sometimes to, you often don't want to be the highest bid in competitive situations. One way that we solve for that is that we're very proactive. Insight spends a lot of time talking to the market, talking to a lot of different companies. We have a value-added arm that also interfaces with the market as well, so that we're able to get some deals through investment bankers or kind of structured raise processes where they're going around and talking, but we're also talking to people and building relationships before they're raising capital.
Mike?
Yeah, I mean, I'm not going to lie, it's been tough to invest in technology over the last 5 years, just at valuations where they are now. We try to pick our spots. If you look at the investments that we've made over the last 5 years, I've probably done half a dozen software investments, heavily weighted towards the 2010, 2011 timeframe. I think I've done one software investment in the last 3 years. We try to pick our spots. If you look at what we've done, we invested in a software company that sells software to the upstream and midstream energy market. It wasn't a recurring revenue. It wasn't a SaaS platform. We invested in a business that sells software to Class 2 railroads. Again, not a sexy business, but that was a highly recurring revenue model. So we try to pick our spots, and identify areas where we can benefit from the wider Carlyle platform. The nice thing about my job is, although there's only 20 investment professionals on our team, we have 700 investment professionals worldwide, and we have folks who just live and breathe in certain sectors, whether it's aerospace and defense or transportation or logistics. So, for that railroad business, we actually have a sister fund that owns railroads. So from a diligence perspective, we understood the market dynamics, we understood what the growth rate would be, we understood what the likely exit would be. So that allowed us to perhaps be in a bit of a forward lean to get the deal done. But absent that, what we think about is kind of a Carlyle angle or an edge. It's difficult, as Nick said, the last thing you want to be is showing up with the biggest checkbook, right? It's the definition of the winner's curse. So unless you can find those value-added opportunities, post-investment value creation, it's a challenging market.
But Drew, from your perspective, when you approach interesting companies that might want to be an acquisition or a partner, is that environment better or worse than it has? Is it overvalued, overheated, or how do you find it right now deploying capital?
On the M&A side, there's certainly no shortage of high-profile transactions on the front of the papers and the trade rags that we see all the time. Yeah, I think it's overvalued. I mean, we're basically paying, in a lot of spots, double-digit multiples for shrinking companies in some instances, which is hard to compute. So needless to say, I've been focusing, maybe as a matter of convenience, but more on the investing side. We're only a year in this investment strategy, but I don't think we have any shortage of interesting opportunities on the tech side. While we're narrow in some respects in what we're looking for, I'm looking as early stages, low six-figure seed round checks, trying to get to companies before they've wedded to a platform. We've got a platform technology that we're really building this ecosystem around and trying to bring it to life with IP from partners. So we'll get to people early and try and get them to build on our platform. At the same time, I'm pursuing B and C round deals that are 8 figures, that have the opportunity to drive more meaningful near-term revenue. So, when I look at that broad spectrum, even if I confine it to a couple slices in the security space, I'm certainly not having a problem staying busy right now. From a valuation perspective, look, in the venture world, made up numbers a lot of times that, there's not a whole lot of science behind, but one of the beauties of being a strategic investor and focusing more on that partnership is, I don't get bogged down in whether I own 5.5% or 6% of the company. I mean, don't quote me on that, but it's not why I'm doing it. I'm trying to drive revenue on our P&L. Valuations are still high in the venture world, but manageable.
Let me pivot a little bit and Mark, ask you. You're the chairman of Tangible Security, a cybersecurity business today that's also being built backed by private equity, but building through M&A. So
Right.
you've got you're in the middle of you have private backing, but you're looking to do acquisitions at the same time. Are you competing with the Mikes and the Nicks and the Drews of the world as you're looking for targets and add-ons to your own company? Say yes.
Yes, absolutely. I hate these guys.
We're getting somewhere.
Yes and no. I mean, I think part of the success, maybe not as binary as success or failure, but a way to continue to build sustained value is not only looking for the partnership opportunities, and money is ubiquitous. So, I mean, if you're asking me, am I worried about finding money? The answer is absolutely not, because you can go to a number of different pockets. And there's also non-traditional sources, too, of capital that figure in there with, the angel rounds now I won't say have supplanted early stage VC, but they're, now on par with what used to be, the classic traditional VC money. So it's not finding the money, it's finding the money, within the context of a partnership and on the terms that enable you to continue to build value in the business as you acquire companies. So a lot of what I try to do anyway is, since I have a background that kind of comes in and out of, government and military and business and venture capital and private equity and operations, is I've built a lot of relationships along the way. So typically the companies that we look to buy aren't for sale. So, the two companies, actually including Tangible, that we've bought, none of them have been for sale. The other companies that we have LOIs on aren't for sale. So, it's more built on a relationship so that you kind of demystify what's the cultural fit going to be once you bring the companies together. You already have a relationship, you're working together in the market and those type of things. But invariably, sure, you do compete. I don't think we'll ever run into to Mike and his group in terms of the capital that we're looking to raise to do these acquisitions. But it's nice to know that people like that are out there that you can go talk to as a sanity check. And I have relations with a lot of different funds, and in fact with Carlyle's growth equity fund. So, and they've been actually very good about sharing some information. So it's more of a cooperation, and sometimes it leads to a partnership together, and sometimes it doesn't.
I'm going to pivot a little bit into more technology. We're not technologists per se, at least I'm certainly not, and most investors are not. But in the technology space, if you think about the last 3 to 5 years, and maybe, Mike, to your point, we need to go back 4 or 5 years to get to like your last really hardcore technology investment. What's been the sort of sweet spot of the best companies you've found, the best investments you've actually made? And was it getting the sector right, getting the value right, just catching the tailpipe of a rocket ship as it took off? What was the driver of success, and what were some of your best ones, or best one of the last couple of years?
I guess if you look back at probably our best investments, I think the common theme is really strong management teams, right? It's guys like Mark. If we back strong management teams, and if I'm in there, something has gone horribly wrong, right? So I think that if you look at it, I think that's been the common theme. We have a view that we back strong management teams. The phrase is no auditions. Have they made money? Have these teams made money for investors in the past? Have they managed through up times and down times through different economic cycles? Have they built a team that scales? Are they coachable? So I think we really focus on it's the teams. Dave, I think an example would be Coalfire, the recent investment that we made together, right? If you look at the CEO there, Larry Jones, he's a 6-time CEO. He's managed private equity backed investments. He's been a 2-time public company CEO. He's managed much larger businesses. Right. So in that case, you feel really good putting capital behind someone who's been there and done that. And I think over the years we've tried to institutionalize it. We always joke, we spend so much money on lawyers and accountants for our diligence process, but we rely on our own intuition to assess management. So we're trying to be a little bit smarter about that. And you're relatively agnostic by industry, so you can. We are.
You don't have to bet. You don't have to find one particular sector. You can go where the best management team, whether it's software, technology, services, all across.
Exactly.
All right, Nick,
Yeah.
why is Mike all wrong? So what is he doing
No,
wrong?
Mike is doing great. So team is incredibly important. Market and market size. For smaller size companies, it's that initial product market fit, and have they really built an engine that can scale, right? So are they able to not just have the founders sell it, but actually start to have a sales team, whether it's inside or an external sales team, that is able to repeatedly find and diagnose where that pain point is and sell that product or solution into it in a very repeatable manner. And so that's the kinds of things that you get into in diligence.
Okay. Let me ask, again, on the technology side, and Drew, you might be the expert here for us to start this, which would be, what zones are you looking at? Looking forward to, you've got a long-term horizon. You don't have to return capital to LPs in a time frame. You've got a corporate balance sheet to work with. What veins and are you trying to get into? What particular markets or products do you see as growth areas?
Sure. I mean, there's a couple different ways to slice it. I mean, we're really looking. I mean, there's a couple plays we make. I mean, one, we've got a platform again. You know, we're trying to find good companies on which we'll build on our platform and frankly, pull through our products and drive revenue. You know, at the same time, we're looking for bolt-on technologies to our platform that help enrich it. You know, three, we're looking for, I would say, I call it domain-specific capabilities. So in the cyber world, you know, somebody who brings us some interesting cyber algorithms we can layer on top of our platform, et cetera. So we've got a bunch of different tacks. Broadly speaking, we try and find technologies that we can leverage across domains. So whether it be in cybersecurity or also maybe finding the bad guy in a more traditional or tactical sense. You know, but to cover as most ground as I can, I mean, we're looking very actively in what I'll call huge bucket here, data fusion, science and analytics, threat intelligence, again, broadly speaking, is a very big area for us. I mean, we're trying to bring real-time situational awareness and intelligence to a number of different domains, and there's a lot of different routes we can take that in a number of ways. I can slice it, but at a high level, that's kind of the gist of it.
Mark, I'll go to you. Within Tangible, you're obviously already in the cybersecurity sector. When you think about cybersecurity, where you want to take Tangible, are there, you know, how do you define the subsectors? And cyber means a lot of things to a lot of people. How do you break it down into where you want to go and find the biggest opportunity, the most growth potential for that company?
Well, in the broadest sense, starting with the general and then going to the specific, in the broadest sense, through the acquisitions that we've made, we've tried to build out the network security focus that the company had when we bought it a few years ago in and around it was more of an identity management security software as a service that has been, you know, now we created an entity inside Tangible called Tangible Labs, and so we've made some investments off the balance sheet to turn that into a product, and it's now on every domain controller within DoD. So part of the business within network security for us is we've got a pretty deep history in identity management, you know, software security and services. First acquisition we made was oriented around giving us a deeper understanding of network security from the perspective of people who actually, you know, break into networks. So on the offensive side, we do a variety of different things, but the specific markets in there that we are looking to inform and hopefully influence are people, mostly manufacturing firms, that are trying to get out in front of of what people, you know, think is very disruptive, but to me is kind of a natural evolution of the internet, which is the Internet of Things. Once you create all these industrial systems, you know, you have the same typical vulnerabilities that you have in any other network. So we want to make sure that people who are designing these industrial systems, who are writing code for broader system of system type architectures, that they're designing security in on the front end. So that's a market we want to try to be in, but we also want to underline, you know, the work that we do in and around network security in both commercial and the DoD side with, you know, good systems engineering capability. And some of the things that you were talking about before, you know, having an analytics capability to support the deployment of software and services for us is pretty important.
Nick, do you personally, or within Insight, do you spend time doing planning, futuristic, you know, looking in the crystal ball, big themes we want to go pursue? This is going to be huge for 10 or 20 years. And
I think there are some themes that are going to carry for a long time. So obviously the cloud, data, mobile, and there's within those. It's the question is what are the opportunities, right? And so cybersecurity is obviously a really big and important area. And so we were talking earlier about insiders, and so privileged account management is definitely an area that we're interested in, and so we're investors in Thycotic. How do you manage all of the firewall and infrastructure that you've got in a kind of continuous way? And so that's why we're investors in a company called Firemon. So there's pockets of cybersecurity that we're particularly interested in. I think you also, especially for high growth investors, just to distinguish us a little bit from Carlyle, we also look for big paradigm shifts, right? So on the consumer side, we invested in Twitter and Tumblr, and on the enterprise side, we are investors in open source companies like Docker and Mirantis. So Docker is pioneering this idea of containers, and Mirantis is a private cloud infrastructure that was actually commercialized out of NASA. And so these paradigm shifts have opportunity for really large growth, and that can be really exciting and generate some substantial returns.
it's interesting. And what about, no one said the word, and the theme today is around security and privacy. Have you found that as an investable theme? And the answer may be no, but are you seeing sort of opportunities that apply to your model, fit your thresholds within privacy specifically?
So I'm on the board of a data analytics company in K-12 education, and privacy is a big theme in K-12 education. And so the opportunity to come out with products targeted just at privacy in the context of there's COPPA, there's FERPA, there's a whole bunch of different regulations just in the K-12 education space. So that means that there's a lot of hunger for a privacy data analytics product.
Let me ask, if I can ask you, put your humility hats on for a second. Investments you've made, in hindsight, you missed something or did something wrong, and it's made you a better investor to say, okay, well, our process needs to now incorporate A, B, or C in our diligence process, or we underestimate the importance of this or that. Where did you stub your toe and learn from it that, to be a better investor, we need to go spend more time in a certain space?
Yep.
Anybody?
I could try this one. So this actually predates Carlyle, and it wasn't an investment that I made, but an investment I missed. So when I was in graduate school, I focused on supply chain and operations, and was introduced to this startup company called Kiva that made robots to automate the pick, pack, and ship operations in distribution centers. And took a look at it, and it was in a warehouse in suburban Boston, and a bunch of guys with propellers looking at these items going across the floor. And I had the chance to invest. The company was pre-revenue, actually pre-customer at the time, and so in an angel round. And about that time, I'm graduating from school, and I'm looking, wow, it's a long and lumpy sales cycle, and you're selling to retailers, and it's razor-thin margins, and speaking of razor-thin margins, I have a whole bunch of college or business school debt. My wife has law school debt. So my wife wants to buy a house, so we don't invest, we buy the house. You fast forward 3 years later, and I'm working for Staples up in Boston in their supply chain operations group. And who is Kiva's first customer? It's Staples. And they sign up a $21 million pilot. So every day as I'm going into work, I see Kiva running the floors of these operation centers. Great. Fast forward to 2007, we sell our house in Massachusetts so I can move down to Carlyle. We sell the house at a loss and move down to Carlyle. Fast forward to 2012, and Amazon buys Kiva for $750 million. So I guess two lessons learned there. One, don't tell your wife the house we could have had if we had invested in Kiva. And secondly, just for me, I learned that I am not a venture investor. Like I am risk adverse. Like
Right.
cash flow burn gives me heartburn, right? And that's like Nick. It takes a special breed, and I don't have that. I'm kind of a skeptic, and I can find that soul cloud in the otherwise bright sky. So
I was going to blame your graduate school education, but you and I have the same degree,
Exactly,
so that would be
exactly.
a bad idea.
so that was probably my biggest miss or regret.
Interesting.
As a strategic acquirer, of course, I've never made a bad investment. It's one of the beauties of it. You just integrate it, and then you muddy the water, and you have no idea what happened. But
It's a big balance sheet, Drew. It's a very big balance sheet.
and on the investment side, ask me in 3 years. But of course, I've never made a bad investment.
I can go back to my venture capital days.
Please.
For me, it's really been, like Drew was saying before, a lot of it's, early stage venture, a lot of it's made up. Numbers are made up. It's more of the promise of what could be. So it's, I joke around that I've been fortunate enough to get a lot of degrees, but the one degree I should have got was psychology, to really understand, how teams function, either together or not. But it's a question of the investing I've done has really been technology centric. So really thinking that you have the technology nailed and everyone has to buy this product because it just makes so much common sense. But you tend to get sometimes focused on the merits of the technology and less on the limitations of what it's going to take to go to market and over what time frame. So you can get the technology piece exactly right, and that can be validated, like Mike was saying, in other instantiations where it shows up and it works and all of that. But you just missed the market timing because you just didn't really consider the impact of what it would take for people to, no pun intended, but acquire the mindset to acquire that product. And that's oftentimes hard to do with early stage companies.
Yeah. Is it nice to have or need to have? And I would argue, I used to do even earlier venture capital at Polaris Venture Partners and then Lehman Ventures. And in very early stage investing, some of by definition, if everything you're investing in is working, then you're probably not taking enough risk. The absolute best venture capitalists in the world, they write some of their investments, actually probably a majority of their investments, down to zero. And so they're taking really big risk, and they're pushing their management teams to go after really big opportunities and think big. But the nice to have versus need to have is an important distinction, and not getting infatuated with the technology, because it's possible to have the just fantastic mousetrap that is so amazing, but if that doesn't actually, if customers aren't if they aren't really pulling those off the shelves, then you're not going to be able to build a scalable business.
Okay. I'm going to ask one more, and then we've got room for questions from the attendees. But let me ask one more. I want sort of each of you to think about it and give an answer, which is, sitting here today, if you were talking out to the audience, to the next generation of you, and you were trying to say, okay, if I was going to give advice to someone who wants to become the next partner at a venture capital firm or CEO or Carlyle or corporate venture head, what's the advice you give them today in this environment to think forward? Here's the advice I'm giving to a younger version of me as they set forward for the next 10 or 15 years.
How far back do we go in their career?
It's a good question. Go ahead.
Well,
Whatever
the first
time
thing I
frame
would say is, given the cycle times now for technical innovation, particularly in cyber and other areas, are I think as fast or faster than we've seen in a long, long time. And from a market dynamic place, I think you can make an argument that we are, in a lot of ways, back in 1997 and 1998. So if you're trying to have a fundamental understanding of how things work, of course, with absolutely no bias here, a good understanding from an engineering perspective of kind of how things work and how technology interacts with each other, because it's going to influence every industry sector, everything you
start as an engineer.
Interact with. So start as an engineer.
Maybe aviator first and then do engineering?
No, engineering first would be fine. But I think that's one thing to keep in mind. And then, as you grow in that progression, just be open-minded about things that are going to take a different turn than you think that they will. Markets that you think, for example, are going to continue to mirror what they're like now can abruptly change. And so trying to be kind of creative in terms of how you think about what the next problem is going to be that needs to be solved. I think engineering teaches you that, as do other disciplines, of course, but it's a good core place to start.
How many engineers do we have on the panel?
Degreed or real?
Either way.
I was a history major, so I'm completely out of luck.
I'm an MBA. So.
There you go.
I was going to say humility, intellectual curiosity. Those would be two of the big ones, and focus. Right, no one's going to know everything, and so if you have that intellectual curiosity, but also you're going to focus, and whether it's on the product side or on the engineering side or or on a particular market or trend focus is very helpful.
Okay.
I think, at least from my experience in the industry that I work in, I put a lot of value on folks with prior operating experience. We hire a lot of kind of the best and brightest from finance, and they spend 2 years on Wall Street and then come work for us. And they don't necessarily have an appreciation of, they run all these complex gee-whiz models and these forecasts, and profitability should go up and market share increases, but they have a tough time translating that or actually understanding what actually happens day to day. So for me, I encourage the folks who come into our group is try to get as much operating experience as you can. Makes you a better investor, I think.
So inside a
agree.
corporation, like really get your hands dirty, roll it up, not in the finance function, but in an operating role.
I totally agree with that. I mean,
Yeah.
if you really understand how a P&L operates and the trade-offs that you have to make every day operationally to make things happen, I agree with Mike. I think that's invaluable.
From my perspective, I think there's a whole litany of criteria that any MBA can sit down and walk through, but I think I've learned that there's a softer element of things. I think somebody had mentioned the cultural aspect earlier. My previous life, we saw a bunch of acquisitions head south just because there was a cultural loggerhead on the investment side. We've got one extremely successful company in the portfolio, but they're so busy right now shooting 5-meter targets, and sometimes from a cultural aspect, how successful will the partnership be? That's a matter of circumstance, but I think as you look at the partners, you truly need the good partner, not just a good investment, particularly given how I'm looking at it. Because I want somebody that's going to understand what we're trying to do, is going to work very closely with us, always be engaged, and always be looking at not only their story, but the joint story. So the softer element of things, I think, is something that gets underplayed a lot.
Okay. We've got a couple minutes. We'd love to have a couple questions before we turn it over to General Hayden.
Yeah, hi, my name is Brian Collins from a company called Adaptive Mobile Security, which is in the mobile security sector. I'm just on the way through back from California, and I was at a conference where the overriding term was the talk of the unicorn company. Now, when I was a child, a unicorn was a mythical creature. Your view, do these companies exist, or are they different things to different people?
It's probably in the VC world.
Yeah, so unicorn refers to companies that have privately held venture-backed companies that have a market cap set by investors of $1 billion or greater. And I think, was it 80, or is that the number of unicorns?
I think it's over 100.
There's over 100 now of these so-called unicorns. And there's this preoccupation in Silicon Valley sometimes with hitting that metric of being worth $1 billion on paper. But that doesn't really reflect the progress of the business. And of course, there's going to be a number of those that are not going to be worth $1 billion in a few years' time. And there's some that will be worth billions of dollars, but maybe not. They'll be at a flat valuation. That is, they'll spend years and years kind of at that particular valuation.
So my question is for anyone on the panel who wants to take it. I share an office with a VC firm. They have experience in health IT, kind of a small firm. They don't really do angel. They do a little bit later than that. And they're constantly peppering me with questions, and I'm going to give the questions to you, about whether they should get into cybersecurity. Is it really that hot? Is it going to last? Do they need cybersecurity experience in their firm before they dare get into that? Should they really be afraid of investing in a Silicon Valley company if they're based in New England? So anybody have any advice I could pass on to them?
They should definitely invest in companies that are mission critical, cyber, cloud, forensic, big data analytics. That's you gotta have all the buzzwords to get it right.
Yeah.
There's no shortage of teasers that come. Mike, you see how many? I don't know how many of these come across your desk. But.
Yeah, I mean, I don't, not knowing the firm, I don't know their mandate. I guess we try to stick to our knitting and know what we know and what we don't know, and that's why we don't typically invest in true technology companies because we're not a bunch of engineers, and we're always concerned about the risk of someone building a better mousetrap and leapfrogging. Where we have invested in cybersecurity, again, it's been with the help of David's team, who brings a great deal of domain expertise. But we invested in a cybersecurity services business, and so they're technology agnostic, right? And they're very focused on doing assessments for whether it's for PCI for credit cards, FedRAMP for cloud, HIPAA for healthcare. Those requirements are evolving and always changing, and that creates a very fertile and growing market for this services company. So again, not knowing where they spend their time, I mean, that's how we at Carlyle looked at the market, is saying, hey, we struggle with taking the technology risk, but we found a business in Coalfire that allows us that benefits and prospers in a world where there are evolving and ever-changing compliance regimes, whether government or industry related.
From my perspective, it's a target-rich space with a lot of pretenders, and you better know what the hell you're doing. It would be a shame for a new firm to come in and take technology risk rather than just marketing and management risk. I'm fortunate enough that I've got a big engineering team behind me, and we'll get under the hood in our SAP labs and get a sense that the technology is real. We're really just going to take a little bit of management and market risk. But if you've got a new firm there that's going to be taking tech risk, that's 3 strikes in my book. But
Zach, go ahead.
So it seems like there was consensus that the M&A market for tech and for cyber is hot, maybe overcapitalized. What do you think are the biggest reasons for this? Is it just a recovering economy? Is it a weak tech IPO market? What are your thoughts on that?
In my space, I mean, certainly cheap money helps. For all the dings, in particular this town takes, there are some good attributes to these businesses. They have very good cash flow characteristics. They're low capital intensity. There's a lot of money that can be made. One of my former companies, shrank 15%, and private equity might make 2x on it. It's the power of leverage at work. So there's certainly some good money to be made out there. There's a lot of factors at work these guys could probably comment on too, but I don't think it's any one thing.
There's a lot of money out there, and there's a lot of people chasing great companies, and so you have to kind of differentiate yourself and pick your spots. But at the end of the day, I mean, the long-term trend is very positive in the sense that there's going to be continued innovation that's going to help us do things better and cheaper and faster, right? And so I look at the $80 billion of federal IT spend. We're not getting $80 billion of value. And so the kind of innovative companies that we're investing in are the ones that are going to disrupt the market and capture market share and do things better than kind of the traditional players have.
Go ahead. We have time for one more.
I advise a couple of startups. What I'd like to hear from each of you or several of you, what are the discussion-ending mistakes that young companies make when they're talking to you about an investment?
Discussion-ending mistakes, I think, was the...
What gets them thrown out of the room?
Strategy that won't work. In the analysis of where they want to go with a business, I think a couple of things. There has to be a correlation between the amount of money that they're looking to build a business and how they're going to intelligently apply that capital, to move the strategic plan of the business forward. And if they can't make that correlation, and as we've talked about taking technology risk, if it's an early stage technology company, that is aspiring to do things, but it's palpable that they don't have the capability on hand to go do that, that's kind of that's a quick end for me. There's a lot of other ones too, for sure. That's just one that comes to mind.
Nick or Mike, you must have a story of the worst pitch you've seen from a management team.
The best ones are the ones that come over the transcom, right? The ones that are about curing cancer or those kinds of things. And we invest only in software, so those of course are quite entertaining. If you don't understand what the investor does and the type, so we tend to invest in software and we tend to invest in growing companies. So if someone's coming to us with a pretty flat growth company that's predominantly services rather than kind of product revenue, you just haven't done your homework. And I'm sure you see that where people haven't done their homework and approach it.
Yep. Usually will be the Uber of insert industry here. That's usually the...
We are up. Thank you, Drew, Mike, Mark, Nick. Thank you very much for your time and your insights. I think we're all staying in the room, and General Hayden's up next. Thank you.